Hello, hello. Good morning, good afternoon. Who all do we have? Hey, Carl, Dave, Nick, Nyaka, Stefan, Ravindra, Vinay. How are you guys doing?
Good, Vivek. Long time. I've been traveling a bit, so good to attend this.
Good to see you back.
Yeah, thanks.
Right in time for the World Cup finals.
Right.
Who are you guys rooting for? Today's I think today's third and fourth place match, right? France and which other team?
UK.
UK, England, yes. Any favorites? No? All right, let me go to the finals. Who are favorites for finals? Anyone? Who are you guys rooting for?
Not rooting for
Or
Spain.
is it like okay, I have no okay, Niaga says Argentina. I'm like I don't think I have any favorite. I'm like okay, whichever team wins, it's okay. I just want to have a good fight. I just don't want it to be kind of a one-sided match. It's That's all I'm looking for. Let's see how the match. Both. I mean, I think this is the first time that um, European champions and Copa America, Latin America champions are meeting in World Cup final. So should be an exciting finals. Looking forward to it. What else? We'll come to stocks. We'll come to stocks and in the markets, but I thought I should also talk about the one of the biggest sporting event in the I guess in the world. I don't know it's not much popular in the US, but soccer is soccer. Okay, who else? What else? What else caught your attention?
Uh,
Yes, Sam, go ahead.
uh, in the quarterfinals, I noticed that it seems that all the nations are kicking against the whatchamacallit, their colonies.
But yeah, against the colonies or colonizers. At least one thing which we noticed was a lot of uh, countries from like non-European countries have done exceptionally well in this World Cup game, which was very heartening to see that other countries from other continents are also doing great in soccer. Yeah, master and servant. That's true. What else? Most of the players in France team are from outside France. Uh, yeah, I don't know in terms they are um, from outside France, but they are definitely not from European like origin, right? So most of the players are Africa or black players. They're from Morocco. I don't know. I don't know in terms of I don't know how that works. Can you be a national citizen for some other country and then play for another one? Probably they all became and settled in France. There was a meme that I saw, with respect to this Morocco versus Morocco stuff. There was another meme that I saw was World Cup is just like our African players versus your African players. Obviously, most of them, Morocco was part of France. Yeah. Anyway, so I'm looking for some good match today. for third and fourth place. And tomorrow, hopefully, we'll get to see an exciting match between Spain and Argentina. So Spain has only conceded 1 goal so far, and that too during, I think, against Belgium. And Argentina is known to come back from behind. Watching that match against England was amazing. I'm like, came back from behind with 1-0 and then won with whatever. Was it 2 or did they do actually 3? Anyway, that was a great match. All right, so that was a good thing. How about the markets? What did you see in the markets?
Hey Vivek, what are the markets saying about LeBron James going to the Warriors?
I have no idea. I only follow sports for very few. My kid probably would know. She follows basketball.
It's a 23%, 4-1 if you bet it on Kalshi.
Kalshi. Yeah, I'm not on Kalshi. Too old for that or that shit.
Hey Vivek, what's the biggest advantage of trading the markets versus the sporting market? Well, I'm thinking the market is way more liquid. You don't give up as much of an edge. Is that correct?
On
Versus poly market or Kalshi, those prediction markets or gambling.
yeah, so liquid number 2, you never know in terms of these markets are not well regulated. You never know who is already has the insider information, etc. And so trade with the money that you can, just with the gambling money. So I don't do either the sports betting. Number 1, I don't have good insight into any of those, from a sports side. But even on the gambling one, where you take bets on and for an event happening at, so you never know how are those monitored and who has got an undue advantage, etc. or not. That's
Well, what about trading? Isn't that gambling also? Because you don't really know what the outcome is.
So that's why I don't do. I don't trade.
Oh, got it.
Right. Yeah, you can always take a small gamble on trading. That's why I don't focus. So I don't trade. All right. Let me see if anyone is joined here for the first time. Any new joinees here today? Or do we have our regular stuff? Anyone joining here for the first time? Let me also share the screen. Nope, everyone are regulars. Hold on, let me get settled and then we will get started. Ray says my friend is joining for the first time. All right, so generally I would like to get a quick introduction for anyone who is joining here for the first time. And who's your friend, Ray?
He's just my family friend, but I think he's kind of late. That's why I don't see him in the meeting yet.
Okay.
But he's interested in like day trading. I think he read some of the day trading hype. So I just told him, just first of all, I tried to caution him about it. But second of all, I told him if you join this meeting, you kind of get a good like foundational understanding of investing a little more, the basics.
I mean, yeah, I don't hate day traders. I mean, but I've yet to meet few who actually made money on a long term doing day trading. There's always a day which works for you, but majority of the people that I've spoken to who have tried their hands on day trading. In fact, I met someone yesterday at Hackadoja event who have tried their hands on day trading, and they say, you know what? Now I'm out of the markets. But yeah, it's good for engagement, because otherwise investing become too boring. but I'm not sure if in a long term it's great for your wallet. Very few have been able to, especially on the retail side, very few have been able to make consistent money trying to day trade the system. There are, we are playing or against HFTs and the people with very deep pockets, and I don't think us as a retail investors have any edge over there. But it's a great for engagement. If you feel bored, yeah, then day trading is fun. All right, so looks like let's get going. All right, welcome everyone to our weekly discussions around markets, stocks, IPOs, or whatever you're interested in with respect to what's happening on the in the capital markets, and how we want to play with or invest in the markets as a retail investors. So I try to bring some stories that I noticed for the week, and then we can have a further discussion in the breakout rooms if you have any other topics that you want to discuss. So today, what we have on the docket is I want to talk about getting back to the topic of leverage. This week, I noticed a couple of events around how some of those who have, I wouldn't say invested or speculated using leverage instruments, how some of them got wiped off. So you should understand what you're dealing with. Also want to talk about something that shocked the markets on Thursday and Friday, which was around Kimi K3. I don't claim to be an expert in all these LLMs, and I don't think I can give you details of why happened, but we can only talk about what happened. And I would invite thoughts from you guys on what do you think about these things, right? You probably are using these, not these, but its competitor models, etc. in your workplace. So I'd be more interested in as a practitioner, what do you think? What else? We are into earnings season. It got kicked off like last week, but this week there are a couple of companies that I was interested in. So we'll go through some of the earnings next week. We'll look at the companies which are going earnings next week. So we'll review that, and then a couple of company specific stuff. I do have some charts. Little bit update on crypto. I guess that's it. Probably will not be able to go through all as always, but let's try and cover as much as we can. My idea is to give you all the information and so that you can decide on how to play with the market. Sunita says, was the worst day yesterday? No, I mean, come on. We are investing in a stock market, and I think I tweeted about it. And if we are investing in a stock market, really look at terms of SPY was still up 9% when I tweeted this. Today, I think SPY is still up 10%. QQQ is still up 13%. IWM is still up 19% for the year. And the drawdowns that we had is what? 2%, 2.5% drawdowns. And if 2.5% drawdowns is scaring us, I think we should not be in the stock market. 10% drawdown is common in a year. I mean, just assume that in any given year, market will see a drawdown of 10%. And if we cannot live with that 10%, Treasuries is giving you 4% plus, right? That's also you can invest in. If we are investing in individual stocks, and it's not, I'm not saying it's Charlie Munger said, right? If you're investing in individual stocks, be ready to face a drawdown of 50%. Right? If you're investing in the whole market, like SPY, etc., 10% is common. Unfortunately, over the past many years, we have not seen too many instances of these drawdowns, and us as an investors have become little, casual, and I would say have lowered our guard and thought that markets will only go up. But that's not the case. The reason why the markets have returned on an average of 10% over 100 years history is we will have the gains in 20s and 30%, and then we will also have the years in which we will lose 10%, 20%, right? If you I don't know if I have the chart right now, but that'll be interesting to look at on some other day. Is on there are very few years, maybe 4 or 5 years in the history of 100 years, that market has actually delivered closer to 10%. The average return is not actually average, it's an outlier, right? Most of the time markets has either given up way higher than 10% or has underperformed and given way less than 10%. So we have to be okay with the drawdown. So if you think it was a bad day and caused you to lose sleep, maybe look into your portfolio and see what you're holding. Maybe our portfolio is concentrated in one particular sector, right? And those concentrations work well, or if there are some leverage instruments, those work well if you're going up, and then it hurts a lot if the trend reverses, right? So Rajiv, did you react to Thursday or Friday move? Did you sell or continue to hold? No, I did not sell. I just like my regular day-to-day work is mostly delta management, and maybe next week I actually built up a table looking at different option strategies. I thought maybe in some weekend sessions I'll talk about it in terms of what are some of the decisions that I take on a daily basis. Daily basis, the decision makings are not too much. I spend more time in going through the earnings, etc. But all I look at is see, okay, how many deltas do I have? What's my theta number? And then I look at, okay, what trade do I want to do? Do I want to do a delta neutral trade just to increase the theta, or do I have to reduce the delta, or do I have to increase the delta? That's all the daily decision that I have to take. There's not too many of a decisions. But coming to the answer, did I sell everything? Did I sell? No. I think the only stock that I sold, we can talk about now, and not wait until that part, is the one stock that I sold is CrowdStrike. I thought it is, and it could continue to go higher. That's great. I had increased my position a lot on CrowdStrike when the June 19th incident had happened. I thought it was beaten up too much, and the stock is like 4x since then, right? I think it was 2024 when they basically shut down all the airlines and all that stuff. So I do not see the corresponding increase in the business when I run it through my framework. It's not that great from a demonstrated performance over past 10-15 years. Not that great, but it's got a great future thesis around it. I thought it was too expensive. I want to reduce that single stock exposure to CrowdStrike and rather have another fund which have exposure in CrowdStrike. In fact, I'm looking for another cybersecurity fund, maybe to rated capital in that. Other than that, I did not do anything. And then again, CrowdStrike was not prompted because of whatever happened on Thursday or Friday. I think I sold it before it. It was just that I think it was valuation was at an extreme level from my perspective, and I wanted to rotate that into some fund. That's the only change I did. Otherwise, not too much. I think Netflix under $100 was a deal. Now you got a better deal. I think Netflix is sitting at what now, 70?
Is SpaceX a good deal?
You should call up your broker and thank them, saying, thank you for not allocating whatever I asked for SpaceX, because now I can buy it at a cheaper price than what that it IPO,
50% off.
$135 was the IPO. It's like, come on, guys, always IPOs. Look at across the IPOs, it's investors have not made money buying on an IPO or on the day of IPOs. There will be maybe one specific or a few individual stocks in which they have made money. Collectively, buying at an IPO is has not worked out. And looking at a SpaceX, come on, what are we talking about? $26 billion expected revenue in 2026 with a valuation of $2 trillion. Sure, it's all about Elon. It's all about Elon, nothing else. So I will wait. I will wait for SpaceX. Maybe, pick up a few shares, very small percent of portfolio so that it stays on your radar. That's the stuff. If I want to do, I will probably do it. But I don't think I'll need to do it for a SpaceX because it will always be on the radar, right? It's not the stock that you will forget about it if you don't hold in your brokerage firm. Has happened with me in the past wherein I looked at the stock, reviewed it, then I thought, okay, seems very expensive. I'll look at it later, and then I forgot about the stock, and then it went through my pricing and I never bought it. But I don't think I need to do it on a SpaceX. It will always be in the news. SpaceX will be in the news always.
Hey, Vivek, you could sell $100 puts for like $5. Implied volatility is like 98%. So that's one way to play it.
Yeah, if you think the $100 is great for SpaceX, sure. I just want the SpaceX to go through a couple of quarters before I get interested in it. So maybe I'll buy one share just to keep it on my radar. But yeah, it's a high volatility. Will be high vol stock. I mean, just can you trade it? Great, could be a great trading instrument. But I don't know at this point of a time. I am ready to buy SpaceX as a long-term hold. Just want to trade a vol by selling options against it. That I won't mind, because
what about selling? Stock,
it will have a decent, good premium in it.
Yeah, you could just sell like put vertical credit spreads, right? Like $100, and just generate income every month from it.
Yeah, but another thing I want to caution, because I saw a lot of folks on Twitter, right? Those who discovered on Twitter, a lot of people recently discovered short puts, especially on the tickers like Nebius and Corvi with the high vol. And some of them are now swearing off selling puts ever in their life. Again, the vol is higher for a reason. I've seen the similar story in 2022. I would say like in 2020, a lot of people get attracted to selling puts because the market was going higher. We had an extreme euphoria in the markets. Many companies that had no business to be in the public market came to public, captured our imaginations. A lot of investors, or I should say speculators, thought these are the good companies, or the companies had a high vol. You could get a decent premium, and many sold short puts. What they realized in 2022 was it was a stupid mistake. You should know if the business is great, if you really want to hold it. You don't get put premium is an icing on the cake. The cake is the stock or the business that you're selling your put on. Make sure you love the cake. Otherwise, you'll end up, and it has happened. I saw on Twitter, I joined one space, and now they're saying you will never sell the puts. Because now they're stuck with the like Nebius, and when they sold the put, and the stock is so far down. And now they're realizing that is not a good quality stock. You love the icing, but you bought the damn cake with it. So be careful. You want to sell a put on SpaceX? Great. Don't complain later on if the SpaceX become $50. And then whatever, $5 of premium will not be enough to cover all the losses. lot of folks have learned the hard way. I have done the similar mistakes earlier in my option days. Get attracted to a lot of high vol. The vol is high for a reason. If the business is good, great, go ahead and take a position. But I have seen again, and won't be the last time, when people get attracted towards selling a huge, attracted towards the high premium in options and ignore the quality of the business that they will be stuck with once those options get assigned to you. All right. Let me see a few more comments. Investor looking to take some hefty profits. Leverage traders. Rajesh, the money has flowed out of strongholds. Look out for below gambler triple leverage Koreans. I'll talk about it. So we'll look into that. Anyway, let's get into the too many comments. But if there is any specific question, raise your hand, unmute yourself and ask it. Otherwise, I'll be just reading all the comments. And the whole time we'll go and read in the comments itself. Okay. All right, let's dive into today's session. As always, anything that we discuss here is only for your education or maybe a little bit entertainment, but don't trade solely based on what you hear in this session. Okay. All right, last call. Anyone joining it for the first time? We got almost 28 people. Anyone new joinees here? Before we get started. No? Cool. All right. So I think Sri talked about the leverage ones and Rajiv was talking about the Koreans. What's happening? This is what happened in the Korea. Koreans ants got crushed. Was there a documentary or something on YouTube which I was seeing not this week, but I think a week ago or 2 weeks ago, was the Korean ants, right? So the the retail investors are called ants in Korea because an individual ant can't move, doesn't have a large impact. But when the ants get together as a group, then they can move big things. So the whole the documentary was around how the group of retail investors or traders or speculators in Korea got excited about many of these individual stocks, and now they've gone big, and a lot of money from them is moving the stock market in Korea. It works well as long as it is going in a direction. But what happened this week? Huge number of Korean retail investors got margin called. I think the number is almost 3% of total population or investor population. We'll get to it. 3% of total adult population received margin calls.
1.2 million.
1.2 million retail accounts, 3% of overall population. That would be close to, we are looking at 10 million, or I don't know how much, let's say, retail population in US would be. Let's assume we got 350 million overall, and half of which is adult population, or maybe 200 million is adult population. We're looking at 6 million margin calls in the US. So what happened? This is KOSPI, which is Korean index. It's actually a stock market index, but it more behaves like a meme stock because it's got such a huge concentration. Two companies constitute 50% of the stock market index. And here we talk about US market is concentrated. Look at the Korean market. No points for guessing who those companies are. These are SK Hynix and the Samsung, right? So these are the two companies, and they constitute 50% of the Korean stock market. From KOSPI was close to $9,000. Sorry, not 9,000, and in June, and then it leveraged down to whatever, close to 7,000 not, you don't see, it's not uncommon to have a stock market correct, whatever, 15%. It's not too regular also. But that's okay. But what happened? Lot of why did this caused a widespread margin calls, and now it has actually, regulators are stepping in to ban some of the products in which the South Korean retail investors got into. Right?
No, careful. They are only creating restrictions for new products to emerge.
Yeah.
But the existing ones. So what I'm saying is, once this thing has got started, be aware of, yeah.
So how this all started is just like our president, South Korean president, in June 2025, he said we should now focus on building wealth, rather use stock market as a primary wealth building tool, and not just put all the money in the gold and the real estate. So he was also the South Korean president also considered stock market performance as a barometer of his own presidency. And then, the regulators became little lax in terms of approving a lot of products that could be traded on South Korean exchanges. So, and then you start to see flood of single stock leverage products, right? First of all, leverage product itself is risky. Then you have a leverage product on single stocks. And then the lot of South Korean retail investors started moving into any of the, many of these leverage products. There were stories around people taking on loans to invest in the stock market, especially companies like SK Hynix and Samsung, right? By mid-2026, AI infrastructure, memory chip super cycle, we are all aware of this, right? We are seeing even on the US market, what's happening with Microns and the SanDisk of the world, right? These companies these accounted for more than half of the entire index weight, right? The total margin loans, retail investors taking on margin to invest in these companies, peaked an unprecedented 38.6 trillion won, which is almost $23 billion. More dangerously, 2x leverage SK Hynix. Right? It ballooned to 20-fold. Seems like easy money, right? The stock is just going up. So just buy it and you make 2x. Right? The trading volume was 4 times the volume of underlying cash equities in these leveraged products. So whenever, it's not the first time, won't be the last time, have seen these stories time and time again. Whenever this washout happens, somewhere someone has gone too big in some position, got margin calls because they did the stupid things, got leveraged or became too big, or everyone was piled up on one side of the boat and it's going to topple. So what happened? Why did this crash? The peak occurred in June 18. We talked about it. And it's not that the memory stocks or the semiconductor stocks, they crashed a lot. They didn't crash 50%. We have a normal correction. Stocks go down 15%. That's normal. Individual stocks, right? But the issue, what happened with Kospi was structural position crowding. Everyone was crowded on the similar stocks, and then leveraged, and then margin loans. And the other thing which Bank of Korea did was to contain inflation. They maintained a high rate interest longer than the borrowers had anticipated. If you listen to Ruchir Sharma, and he's been bearish around the current market for I would say a few months, almost a year. He's looked at the lot of crashes that have happened over last 100 years, right? In all of those crashes, all the bubble burst, one common thing theme across all those bursts are increase in interest rates. Right? Pick any, right? Whether it's 2000, etc. There will be technological revolutions, or the high hopes of how the things will be rosy forever, which fuels the bubble. But the pin that breaks the bubble, as per Richard's analysis, is money tightening. 2008, same thing. 2000, same thing. 2022, same thing. Right? And as long as, and the same thing happened, one of the things that happened in the Korean market was also that they maintained a restrictive high rate. So what happened? I think we have seen multiple days when the market corrected, and then market declines, you get margin calls, and that's the same story, right? This is the virtuous cycle of price going up now become a vicious cycle. When you get a margin call, you are forced to sell the stocks, or a broker will sell the stocks that you may not want to, and that puts another further selling pressure on the same stocks. The stock price goes down, which again forces you for margin calls, and it's a vicious cycle that people get caught into. So, like Rajiv was saying, 1.2 million received margin calls. Between 320 to 350K were completely wiped out.
And some may not have been completed because Friday was a holiday, so Monday will be a bloodbath day.
There we go. So the story is not done yet, right? And now what the market makers, and I think even before this washout happened, when they saw, it was I think the last week, where they saw that the Kospi was going through a swing of 9%, 10% drawdown, and it hitting the circuit breakers multiple times. The regulators, they actually issued a statement that I think it was a mistake to allow these leverage products to trade on the market, right? So now what they're doing to contain the risk, whatever their FSC is, like their financial services regulator, now they're increasing the minimum cash deposit. They made it now 3x, so that you don't just deposit a token amount of a won, and then you can take a leverage. If you want to have that margin accounts, the amount of a cash that you need to keep in your margin account, now that requirement has been tripled. The ban on single stock leverage derivatives, any new leverage or inverse single name products, right? Probably you could still do it on an overall index, but on single name, they will be banning it. Like I said, the regulators already kind of did a mea culpa a week prior, saying it was a mistake to approve these products. And the brokerages are looking at, hey, should we have margin call them, or should we have given them a longer grace period and all that stuff? So while South Korea has realized that it wasn't the best thing to allow all these leverage products, we in the US have been approving some of these with the new SEC in place. Like, we've been approving a lot of these products left, right, and center. Still, I think I consider US to still be little cautious than the European market. I believe, and somebody can maybe fact check, but I believe in European market, you actually have 5x leverage products. I don't know if it is on a single stock or not, but thankfully, we don't have those 5x leverage products in US. Not yet, but I don't know what Paul Atkins might do in the future, but at least I think there were some of these hot sauce issuers had put in an application to SEC for the 5x products, and SEC say, no, sorry, not right now.
Actually, Vivek,
they still have 2x, 3x.
Charles Schwab gave you 4x starting this past Monday.
So all of your brokers will be reaching out to you via emails, because starting 1st of July, the pattern day trading rule have been kind of abolished. Now you can go ahead and even if you have $2,000, I don't know what the new limit is, or probably there's no limit. You can just go and trade your heart out, right? As much as you want without invoking the prior pattern day trade rules.
And they just changed it where you only need 25% of margin. Before it used to be 50%. Now
earlier it used to be 50%.
Now it's 25.
Yeah. But remember, these brokers allowing you to trade margins doesn't mean that you should. Brokers will protect themselves, right? It's like company is telling you, yeah, go ahead and take a loan. You can take a loan on $10 million worth of whatever mansion. Doesn't really mean you should, right? You need to see your own position, and the broker will protect themselves. Now, in these cases, right, brokers didn't lose money. They liquidated the investors or traders or speculators. They didn't lose money. So Charles Schwab will want to do it because now Charles Schwab is also, he's competing against all these neo brokers who are taking business away from Charles Schwab. So they'll do whatever is required to attract the new crowd of investor, right? And new breed of investors. They want to take big leverage, higher leverage. They want to, speculate and trade in a lot of speculative instruments. I won't be surprised if Charles Schwab's, they'll add all these prediction markets and crypto, etc. That are already in their plan. But that doesn't mean you should evaluate your own position. I received email from Charles Schwab saying, hey, you can have a higher margin. I'm like, dude, I'm not even using the margin which I have available right now, right? So I don't even need a board margin. But yeah, they've been doing this outreach for all their customers, right? So that was, we talked about what happened in Korea. But something that also happened this week in US market. Probably, it happened with one stock, but I want to circle back to the discussion that I have had multiple times here in terms of a leverage funds or 2x leverage funds and why you should not hold it for long period. These are the instruments that you could hold it overnight, maybe a week. These are day trading instruments. These are structurally should not be held for a long time. But I've said, I've heard people talking about it. Yes, I'm holding whatever SQQQ, right? Or NVDL in my portfolio. Right? That's not investing. You want to hold NVDL just before earnings? Sure. Go ahead. Won't be mad at you. But you're saying you've been holding NVDL for 6 months? Come on, what are you even doing? So here's a story that happened with Lucid Motors. Anyone own Lucid Motor stock? Ticker symbol LCID. All right, looks like there are no owners of Lucid Motors, but this could apply to any leverage individual stock product. Okay, so what happened? The holders of 2x Granite shares. Granite is again one of those hot sauce issuer. LCID, I think the ticker symbol is LCDL. They got completely wiped out. Complete wash out. Zero. So what had happened? Right? So on July 14th, Lucid Motors saw a decline. There was a news, we'll get into that, but then it recovered. Damn, the stock is even higher than where it was on July 14th before this sharp, drawdown happened on the stock. So if you're holding a leverage stock, you're like, wow, should be fine, right? You saw a drawdown, but you're up. So probably if you're holding the stock from whatever $5.50 to let's say $7.50, which is close to 40% increase, your leverage fund should be 80% higher. That's what the 2x leverage is supposed to do. Isn't it? Plain math? Isn't that's what we buy these leverage funds? That if a stock performs X, it will perform 2x. But I think that wasn't the case. Unfortunately, all the holders of LCDL learned a harsh lesson only after losing money in terms of what they were holding. Right? So what happened? There was a news on 14th. I mean, first of all, Lucid Motors haven't been doing that great as a business. There have been some issues around it. They fired, they reduced their workforce, changed the CEO, and then, had a temp CFO. The number of vehicles delivered was very small. And the what caused the drawdown was there was a news that they have they're working with a company called LX Partners, which is generally a boutique bankruptcy firm. So that there was a news in the market that maybe Lucid is looking, heading towards bankruptcy because they're working with this firm. That news caused the Lucid stock to drop almost 60%. It's just happened intraday, right? And then the Lucid immediately issued a clarification to an SEC, filing with an SEC saying, like, hey, these are all rumors. We're not talking to any partners. We're not talking to LX's partners, whatever the market is saying. So all these are rumors. And the stock recovered. From whatever $5.50, the stock is actually up after 2 days to close to $7.50. But unfortunately, this intraday drop down. Not that the stockholders are still okay. They're probably happier now than they were a few days ago because the stock has done better before the news. It is even higher than where the news before the news was released. But what happened to LCDL? Most of these stocks, if you're buying these leverage products, most of these products, the way they are constructed is they don't hold the underlying stocks. The way they do is they have a swap contracts with another Wall Street firm, right? If the issuer of this is Granite probably, I don't know who the other secondary the counterparty is. They might have had a swap agreement with JP Morgan or Goldman Sachs or one of the Wall Street firms saying if the stock goes up X%, you'll give me the 2X, the difference, right? So, and then that's how they will return 200%. Right? It's mostly based on swap contracts. But do you think these Wall Street firms are foolish? They will protect themselves. So in the swap contract, in page 238, which we'll never read this front prospectus, that how these contracts are formed. In the swap contract, to protect themselves, whoever the counterparty was, they had this agreement that if the underlying stock dropped by 50% or more intraday, the counterparty have a right to terminate the transaction to protect their own balance sheet. So on July 14th, when the stock had an intraday fall of close to 60%, I think 57% or something, it was more than 50%. That counterparty said, okay, stock goes to zero. We are liquidating everything. And now we do not have that swap contract going anymore at immediate notice. So total extension of LCDL capital. Whatever capital that was with the third party, whoever the counterparty was, they said, our contract is done with. And all the holders of LCDL, they lost all the money. Stock has recovered, but who cares? The swap contract is no longer valid. So even though stock has recovered, Granite shares cannot go to the counterparty and say, hey, now give me the 2x of this recovery. No, our job was done. It's like option has expired. Right? Doesn't matter if you bought a call option, but that expired on 17th of July. If the stock goes whatever 40% higher the next day, it doesn't matter.
Also,
You're already out.
the calculation of this leveraged products requires that the value be reset every day.
Every day.
So,
Yes.
so mathematically, if you do the math, this is one interesting thing I found. Like, it's not the cumulative kind of effect, but rather a different math. And so it turns out to be negative when the thing is choppy. The underlying is choppy, like goes up and down, up and down. Like in the last 45 days, when I posted just now, SOX has gained 1.93%, but SOXL has actually become minus 27%.
Yeah, so I've run this simulation, I think, many times. So I had one Google sheet, which maybe we can bring that up, in which you try to, I give a 2-time period and see where the underlying ended up in those 2-time period and what the leverage funds on ended up. And I've seen many times that the underlying is actually positive and the leverage fund is actually return negative, because like Rajesh said, the value is calculated on daily basis. So when you're holding these leverage funds, it doesn't matter. The end state doesn't matter. What matters most is what the path that the underlying took to reach to that end state.
It's a path-dependent option.
It's a path-dependent option which you have no control on. If the stock corrected 20%, 30% in the first week of your holding, and then it started going up 5%, 10%, then corrected 20%, then going up 5%, 10%, maybe in 6 months, the stock is higher or is up 5% on the end date. But your leverage product, you could still lose 20%, 30%. We have no idea. So it's always a gamble to hold these leverage funds for a longer duration. It depends on what path the stock took to reach the end state.
And did you realize it? At least I thought about it. These things are acting at the same way as options do. In other words, there's a gamma exposure now we have.
Yeah.
So let's assume that lots of SOXL contracts written out, or in Korea case, Koreans have leverage contracts there. So as they, starts going, as the index underlying goes down more and more, there'll be a gamma squeeze downwards. So as the underlying is liquidated, more and more of it will be liquidated.
Yeah. Even without that, forget about all these gamma squeeze, which is now we're talking about secondary impact. Just that the way these products are structured, these should not be held for longer term. And I think this is like over the last 6 years, I've told this probably now 100th time, but these things keep on happening. People get so excited about, oh my God, I'm going to make 2x. No, you're not.
I think the US government, SEC, needs to put a stop to creation of these products.
No. I think SEC is not a merit regulator, right? We are a disclosure regulator.
No.
But how many of us actually go and read how these products are structured?
Right. That's why SEC,
no, none of us, right?
SEC was created. Do you know how it was created and when it was created? It was created after the Great Depression.
After 1929.
We had a 10% margin requirement. Can you believe it? In 1929, the margin was 10%, not 50%.
Yeah, so it was a wild west.
There is definitely a role of SEC to be like a guardian angel.
Yeah. Anyway, so every time when I see these stories, I'll come back to the same topic. Do not inventory these leverage products. If you made money, consider yourself lucky and not that you are a genius. Consider yourself that the stock actually took a path which was consistently higher and not a choppy one. And if you are so confident about the stock, maybe buy the stock outright or get, whatever, buy a call option.
Right? So basically it's like holding a future. Because as each day goes up, you are in the right place. But if it goes down, you shouldn't continue to hold. You should be margined out or closed out.
Yeah. I don't know. So now what happened? Immediately on July 14th, LCDL got delisted because we're trying to look at where's the LCDL trading today. There is no pricing for it, right? So even though if you had held the Lucid stock, you're in a better position. But if you held this leverage product, you're out, right? So that's all. Now I think there was something where I read, well, like, brokers are actually putting warnings on your brokerage platform if you're holding 2x, 3x, saying, hey, please understand that you could lose 100% of your investment, even if the underlying still recovers. Please understand that these things could happen. I don't know. That's why I don't trade in leverage ones. Do you want to hedge an overnight risk? Sure. These instruments are made for that. These instruments are made for institutional hedge fund managers to manage an event risk, overnight risk. Hey, you have a lot of deltas in your portfolio. May want to get negative 3x SPY or QQQ. Sure, I want to hold it overnight risk because, maybe there's an election happening. Whatever. These instruments are meant for that. And not for holding as an investment over a long period. All right, that's enough on leverage. Any other leverage stories that we're going to talk about? These things never end. This is the difference between science and the knowledge. Like in field of science, the knowledge is always compounding. But in field of investing, we always start from scratch. Right? That's
Vivek,
every
leverage. Oh, go ahead.
Yeah. So we don't go back and try to recreate, penicillin or some of the basics. So medical science is always additive, but time and again, investors commit the same mistake that our forefathers have committed, or the investors in 1929 had done, investors in 2000s have done, investors during Nifty 50 have done, and 2008 had done, and we will do the same mistake. It's always a new lesson to be learned by every generation.
Vivek, Rob Griffin, or what's his name? Robert Citadel guy?
Yeah, Ken Griffin.
Oh, Ken Griffin. So what he did was he hired the top 10 or 9 psychologists in the world. And basically he figured out how retail psychology works. So he hired them. And so because they see all the order flow, they can actually see the patterns of retailers trading. And then they take the opposite side. And so, yeah, it's all psychology. And you can see why markets move the way they do, because they see retailers are getting impatient, and then boom, they take a position, and then boom, they take it down. It's a psychology. Like, they hired the best psychologists to work for them.
Yeah. So that's why for trying to do a day trade, you're playing against these people. So I don't want to play the game. I don't want to play the game. Play
you can play the game. You can play the game if you understand how retail traders think and just take the opposite side of the retailer.
I mean, market makers always has to take the opposite side by definition of their job. But I wouldn't be surprised if the Citadel hedge fund, because Citadel has both the functions as a market maker as well as a hedge fund. And I wouldn't be surprised if the hedge funds and market maker, there is no China wall between them. The information is flowing, and the market maker function sees the flow, and the hedge fund is making use of it, even though it may be illegal or who knows, right? Anyway. So that's all around the leverage funds. Please, my humble request, do not inventory these. Rather than trying to see where the market will go in future, I have found it's always better to go and see to read the history of a financial markets. That is much more helpful than trying to predict where the market will go. Because we do the same stuff again and again. Right? So not going to be very different this time also. All right, let's talk about what else happened. The other big thing that I saw was around the Kimi shock, or call it DeepSeek version 2, part 2 of DeepSeek. Kimi is a LLM model from a Chinese company called Moonshot. And all happened was they released their new model with 2.8 trillion parameter open weight. So there's a difference between, even our models. I think the Meta used to call it. I don't know. I've never used Llama, but someone who has used Meta's Llama can correct me. The Meta does say it's an open source, but is it an open weight model or not? And in any case, when it says an open weight model means this is like the highest level of open source for an LLM models. Not only you have an access to the code, but you can also change the weightage in it. And this is like an open source model. It means you don't have to pay hundreds of dollars for using this. And after this was released on arena.ai, in the coding they do rank all these models in terms of how good they are on various aspects. In the code generation or on the coding development, this model was the top one, right? Whatever the benchmark is being used here, it was even better than the best model from these frontier model companies, which we call as an Anthropic and OpenAI and Google, maybe Meta, right? And that caused the whole market to question the same thing that we questioned during the DeepSeek last year, that if a Kimi can be the best model for coding and with their pricing which is so low, why do I want to pay for, why would corporations pay for a $50 per million token to Fable if Kimi can do that job in $15? Right? Again, the same conversation, back to the thing, do OpenAI, and Anthropic will ever be able to face this competition, can ever be as cheap as some of these other models are? And then what happens to the $700 billion that we are investing in the CapEx this year, and another more than that next year? If we cannot recover all that, what does that do to the return on these investments? So we saw a lot of these semiconductor companies, these companies were down. Some stocks were down like 10%, 15%, 20%. Another shock. I don't know. I'm not too close to, I don't, how to use these. So we have I know Murli and maybe Nitesh, these people use these things every day. Maybe you'll have a better idea of, are they really so cheap to use? What I heard was, if when you on a runtime, it is still as expensive as some of the frontier models are, but that realization took some time, and I think the market recovered later on. But the initial was shock. Come on, there is another Chinese open source model which can do all these things so cheaply, and everything got dropped off.
So the question is, where did you get this data from? Is it like a legitimate source which can be vouched for?
Yeah, I think arena.ai is being used by and being watched for by many of these players.
Because if the data is coming or backed by or published by the Chinese company, it can be always doubted because
So this data is not being published by Chinese company. So I think I do think probably don't have the detail of arena.ai, but there are like an automated test that run, which is again open source, which checks each of these models, and then the moment you put a new model, those tests keep on running on that, and which will then spit out the results. So these are not the numbers reported by the model provider. These are the numbers that come out of the tests that arena.ai runs, and those tests are also, I think, open source, or you can go and see. And it's like a community maintained test suite.
Got it.
But
Thank you.
yeah, but that was the news, right? In terms of, again, I think we have it. No, can you imagine how much leverage or how much of the capital have been invested in this story that when DeepSeek came, we had a huge correction. So we are like probably one moment away from a legitimate, free model that any other companies can use before we see these 20%, 25% corrections. Now, the questions are, if you really do not need these NVIDIA chips, our assumption is that these companies do not have access to NVIDIA's latest chips because you cannot sell these to Chinese companies. And without using these chips, if they have been able to build $2.8 trillion MOA system, mixture of experts, your context window is so big, then why do we need all those expensive chips? Right? And then why do we have to build all these expensive data centers? And what happens to these trillions of dollars that we are committed to? All the story start to fall on like a house of cards. So again, someone who is more technically oriented can probably go and read the details of what is the Kimi delta tension and all that stuff. But that was the main reason. And now they said Moonshot mentioned that they will be releasing the full weights on July 27th. Will be open for anyone to use. So if you are a corporation and this is being discussed by many CFOs and the CTOs across all the companies, that token costs are going, out of whack. Now the companies are actually limiting the dollar amount what the developer can use on everyday basis, right? But if every CFO is now facing an unprecedented rise in the cost, which they are not even aware of earlier, before they put these budget limits, because the token costs are going through a roof. Ramp, I heard Ramp CEO in one of an interview, they actually added tracking of your token cost, right, into their product so that they can give more visibility to the finance team of, not get surprised when suddenly they realize that their AI token budget has become now 10x of what they had projected, right? Uber famously had told a few months ago, I think maybe in the first quarter, they blew through all of their AI budget for the full year. Right? US companies have started to use these models, these Chinese models. Right? And if that's the case, and if we continue to see the huge disparity between the cost of these models, open source Chinese models, and the closed source frontier models, then why will not more and more companies start to use the open source? Right. That's the question which teams are debating. There are arguments I've heard on the both sides of it. Hey, we cannot use it because these are Chinese. But if it is open source, if you have access to all the code, if you run in your own air-gapped environment, then there is no leakage of data to Chinese, right? And if you have access to the whole code, you can fork it, you can modify it the way you want. Then it is no longer a Chinese model if it is completely open source with open weights and all that stuff. Then it's like anyone's model. You can take the code and do whatever you want to. I mean, I am assuming that there are some MIT license code. I saw it there, which is like a very permissive license. This is from, I think, Zippo, another Chinese AI company. GLM 5.2, it's like number 4. So if you look at top 4, 2 of them kind of open source / open weight models.
So I would say the analogy of this is to like open source software, which needs to be maintained internally in the company. And how many people can you find who will be able to download trillion weight parameter model in an enterprise? Let's say enterprise decides, hey, I'm not going to pay Anthropic. I'm going to implement my own Claude legal system, whatever. So you have to have people who understand at the margin fine tuning of these trillion parameter models. I don't think it'll be easy to. So essentially, they'll end up going to a subscription basis to a company like Anthropic to do that work.
So,
I don't
or
think.
Actually,
the other option could be there will be companies that will be based on providing support and services on this open source. I mean, I worked in a company and our job was to, our product was all open source. Our revenue model was either we'll bundle them in a suite, have, create a products on those open source technology and provide support and services, right? Red Hat is an example. Red Hat does the same stuff. Linux is open source, but then you can get an RHEL, right? So not too many companies have succeeded in making money on open source. Red Hat is one example. I thought Confluent was, but then Confluent got bought over. My own company, were not that successful. But there could be other companies who could come and offer these support services for these open source models. Number
so there
two.
is Vivek.
Sorry, go
I
ahead.
don't know. I don't know if you know the whole composer is built from Kimi, and that is what is Cursor is basically providing. So there is already a solution which has actually made a lot of money out of it.
Yeah.
And comparatively, it's my personal preference. I'm using both Anthropic's ones and composers. It is far more superior. Now it is coming out with a lot of tweaking, but it is far more superior than Anthropic one model.
There we go. So this is already happening. I was just trying to do a parallel of between the other traditional softwares and within these new LLMs from a business model perspective, but it looks like these things are already happening. Even if, let's say, the companies that come out of in terms of providing supports and the services and the products using these open source, even if those companies don't make money, like Confluent never made money, right? But they will kill or at least hurt a lot these frontier companies, because frontier companies have to bring down their pricing. So I think that's a question I believe is market is asking, and hence, we saw the drawdown in the pricing of all these models, the frontier company. There's trillions of dollars that have gone into this. Not only these companies, but a lot of US GDP growth. The previous quarter, I think all of the GDP growth came from investments related to these AI stuff. And that is why any crack or not even a crack, but any semblance of a crack causes the market to shake because of so much of investment in this. Will be interesting to see what happens, but that's what we saw.
I don't know if you remember, we talked 2-3 weeks back around the same topic. I think the main value is, earlier the valuation of Anthropics was based on that their model was superior. That is not very accurate now with all these Kimi models. And because if Cursor can do it, there are other providers who are providing the same model with as comparable performance as the other one. You don't take that much margin out of it. The biggest margin is coming is around the harness layer. So whoever provides the better harness is providing the better service for them.
Yeah.
As for me, a customer, that is more valuable. That's why I say like the behavior between those two drastically change for me.
Yeah, and like those, there will be companies who will be built which is using multiple of these models, and all they're doing is giving you a harness in which you can, based on your requirement, etc., you call these individual models. And there will be these new business will come in. I can't even think about it. I'm not too smart to even understand these things in detail. You guys know a lot more about it. I'm just trying to draw a parallel of what have happened maybe in the past. Look at how big the Linux has become, ecosystem has become. It's an open source, right? So, and if we have spent trillions of dollars, assuming that OpenAI and Anthropic will continue to grow their revenue as they have grown in the past, I think that is now could come under question. If that
And
comes
you've
under
seen,
question,
like,
what happened to all these investments?
I've seen in the Bay Area, at least like in the last 15 years, companies only hand out MacBooks and not Linux laptops to people. Why is that?
Oh, oh, but we also seen in terms of the servers, both of them are run on Linux, right?
Right.
Yeah,
But
the
those are
majority of the
being
infrastructure.
administered by these very I mean, companies like Microsoft or Google, right? We
Yeah,
don't
you can
touch
still
those
provide
Linux devices.
services.
I don't
Yes.
even know what the heck is Linux when I'm asking for something on Microsoft Azure Cloud.
So there will be that's what. So you hit the nail on the head. The models will become transparent. Commodity, you really don't care what is run, but all you care is I'm trying to do this job. And the point which I think was Nitesh and Murali talking about is the harness, right? The companies who will build the harness for you may have like 4 or 5 underlying models. Who care? You don't care as a corporate. Right? Today we are way early in this journey in which as a user you are thinking about should I use model X or Y. Give it a few years, this will become commodity. We may not even think about it. There will be companies who will have a products or which will say, hey, you have this kind of a task. They'll route the request to X type of a model. You don't have to use Anthropic Claude, use whatever the smaller modern instead of LLM, use SLM and etc. and all that stuff. We are way early in
Just a thought on this. Actually, on similar lines, but I have a side take on this. I was connecting what somebody said, right? Why did we use Mac? I think that goes back to some kind of thought process where a lot of this IT organization want to do a copy exact when they give out to customers. And also same thing, obviously, in cloud also, right? When you spin up VMs, they want to do copy exact VMs. And some of the stuff, I feel like a lot of the IT organizations now have the same approach with AI also. They just want to have what is already there, and maybe that's where like all these agents go behind these cloud providers, and it's more agnostic. I don't know, because right now, at least in my organization, they are like, oh, whatever Microsoft provides or whatever our vendor is, we're going to try to source it to them. And that goes back to the other thought where, oh, will people install it local or enterprises? Because we always ask in our organizations, like, oh, why can't you guys just do, instead of complaining about cost, why don't you just put up a server and run some of these local models in airspace air gap
air gap.
mode? But they don't. Yeah, right? I don't know, whatever it is, laziness or copy exact or not how to, yeah, or whatever this new world model is. Yeah, so I feel like this, I don't know, then what I'm blabbering makes sense, but I feel like all this is connected where organizations are looking for a little bit more convenient options to adopt rather than, really a good technical solution. Yeah, that's my take. What do you guys think? Yeah.
Yeah, so the argument around Mac versus Linux, I'll give you the other side of the story. Like as a user, you like the Mac interface, but as an employer, when they are giving you, they need the capability to control all the end devices, which is not very stringent in Linux system. So that's why they prefer the Mac, which MDM has installed, so they can control all their end devices if something goes wrong. So that is the bigger reason for them to adopt to those ecosystems. And considering the cost of it, it's minuscule compared to the server cost, which where actually the most of the infrastructure running. That is the distinction. If you see almost 99% of the servers which are running or the computes which are running is on Linux. Only the end devices which people are using is Mac because there is a different reason for it.
Yeah, and I think Ravindra was saying around, hey, we'll do what Microsoft does. Now, Microsoft is also saying that they will also start hosting these open source models, right? DeepSeek, I think Microsoft, and again, someone who works on Azure, but I think Microsoft already, if not already, Satya did talk about it, that they'll have a DeepSeek available on their Azure cloud. because they're also, I mean, Microsoft has a stake in OpenAI, but they know that unless the token cost comes down, unless the Anthropic and OpenAI and Google's Gemini, unless the token cost come down comparatively to these open source, there's a huge incentive for corporates to start using these open source models. Let's say if it is, let's say 1.5 times or whatever, right? Right now, the difference is like you can do it at 50 cents versus like $10 on this closed source, right? This is a huge, it's a too big a gap to ignore. But if the token cost from a frontier model also reduces, instead of 50 cents, it's $1, doesn't move the needle, maybe we'll stick to them. So, but anyway, this is what is causing so much of a concern, especially in all these investments that have propped up the markets. The whole market over the last, I would say a year or two is all based on these AI theme, right? Not just the AI companies like NVIDIA's of the world. We have memories like Microns, storage. You go to Western Digital, and then you talk about the power, all these AI and AI adjacent. These are what has contributed to the most of the stock market gains as well as to the GDP growth. but if that story doesn't work out, we'll have a huge problem on both sides. So I think that's what is causing us to catch pneumonia, even if somewhere in the world someone sneezes, the markets in the US catch pneumonia.
So while we don't know whether this is the end of the AI highway building, I guess, journey, I think we've seen this story before from 1995 to 2000. There are always, it's like building the superhighway system from 1940s or railroads. It takes like 5 years, right? There'll always be portions of demand and supply catching up, and those would lead to these drawdowns in stock prices. But until like AI has actually permeated into the enterprise ecosystem, which we haven't even started, because coding is the only place where it is kind of permeated.
Yeah,
I don't think you can say that the story is getting over. No, but this is a valid point. You're right. Like this is a valid point for a start of a drawdown.
yeah. AI story, we have just started. I think we have a lot to see on adoption of AI, and AI will get adopted. It will change lives. The only question is the winners of today may not be the eventual winners. So from an investing story, that's not yet finished. We don't even know who will win and who will lose. And all the money, if you're thinking, oh my God, maybe Anthropic and all these chip models, they will win. We don't know.
But it's safe to say that the people on the far end of the funnel, like the semiconductor makers, they'll win.
Yeah, I don't know. On a long way, what if we don't need those such a specialized and heavy chips, right? Number two, I think there's a little difference. So even if you go back and do a comparison of 2000, right? We did all the groundwork. We built the telecommunication system. We laid the whole fiber optic network, without which we would not have an internet what we have today. But all those companies who were involved in laying that infrastructure, they went bankrupt, right? So it is possible that a lot of these companies who are building the infrastructure, they probably will not exist, but AI will. So and that's what I want to be a little cautious on. If we have assumed that these are the winners of the AI era, I think it is too early to assume that.
So now, right now, our discussion has been focused on the very front end, like Anthropic and all. I was just saying that, okay, take this story for what it's worth, but basically, this is year 1995, Jan, Feb, and all. Like all of a sudden, the stock market has woken up strongly, and we are saying that from 1992 to 95, 4, there was a big recession going on, and stock market was kind of sleeping. And all these companies like Lam Research and the semiconductor makers, they're growing gangbusters. And you would know what's going on, right? But essentially, I feel that I could be wrong, but the semiconductor makers and the equipment makers for them and so on and so forth, essentially they are showing the same strength now as of the last 12 months, which we saw before. So kind of like it seems like this AI thing will go a few more years. And along the way, of course, you'll have ups and downs with consumers of that. So that's my kind of take on this.
Sure.
It's just one part of it is like when all of this started, we said we give a lot of credit or the margin to the model training part of it. Like they are costly, they take a lot of cost to build training part of it. That I feel is going to be commodity part because all of these open source will be on the same par with them. Where the growth will happen is on the inference. That is where the larger portion of the usage will be going in. Earlier, like Anthropics has mixed both of them. So you cannot just take their model and run it in different inference. You have to buy them. With these open source, you take the model and you can run it on any inference, like providers which can come as Cursor and other providers can come in, and the inference cost for both of them may be same, but that is where it is the market growth will happen.
Yeah, so I think market is already, we don't even talk about training anymore. We don't even talk about training costs. So that discussion is out of the window. Nowadays, everyone is talking only about the growth in inference, and that's why we're seeing the growth in the CPU. And you rightly mentioned that the cost of running these models, like i.e. inference, that cost for both Kimi and Frontier model is the same. Right?
Yeah, but the margin of Anthropics is coming because their model is superior. That is diminishing, and they are merging both inference and training. Their margin cost is including both of them.
Okay. Yeah. And anyway, so again, the winners are not decided yet. So if you are going too big on any individual companies, assuming they have won the AI war, please note we are in very early cycle of AI war, right? I'll probably date myself. Ask Jeev, Lycos. Many of you may not even have heard these names, but I've used these products. Used to be, who remember the RG Butler? Oh, you don't want to date yourself? Come on, I know some of you probably have used it. So these are for those who these names are new, these were the search engines before Google came into. I remember using in 2000 Lycos and AskJeev. AskJeev used to look so great, much better than, it was better than Yahoo search engine. And I thought, wow, that's such a nice one. And what happened? Google became eventual winner. There were many search engines before it. So I don't know. And that's why I, don't get too big on any individual stock, assuming that they will win, especially when it comes to the software side of the house, right? When it comes to the other portions like fabrications and the equipment, there we have a monopoly or oligopoly, right? There are not too many players. In that case, if we think, hey, we will continue to need to have the chips, or these things will need it in future, the demand will continue to grow, then there are 2 or 3 companies only in every section of supply chain of that on which you could take positions. But when it comes to the software side, I don't know who's going to win. Ravindra say, RG was my first job interview. Yeah, but who knew that time Google wasn't even there? Then Google came and killed everyone else. So I don't know. We don't know where the Google of AI is. What are the companies and the businesses that will be built, which will eventually be winners of this? It may not be OpenAI. It may not be Anthropic. However hard it might look right now to assume that they may not be the winner, the reality could be any different. Let's see another 5 years who will be here. Similar Saturday session, we'll figure out who the winners are. Okay. All right, quick look at earnings, or do you want to look at something else? You want to look at some individual company news? What do you want to do? There are some news on PayPal if you want to talk about that. Any PayPal shareholders? All right, Tom. Bye-bye. PayPal shareholders? None? Okay, Andres says yes, yes. Okay, so PayPal. There was a news around PayPal. PayPal stock jumped up 15%, 16%, I guess, somewhere around that, because now there is a Stripe and Advent International, which is basically a fund. They are combining together to buy. They basically did a bid to buy PayPal at around $53 billion. So let's look at PayPal. And how is PayPal doing? So look at, one sec. PayPal stock. So that's what caused a jump in PayPal stock because of this, buyout offer. But management so far has rejected that offer because they feel it is too less. I think the buyout offer, it is around $60 or something, $53 billion, but management has already rejected it. What do you guys think? Why do Stripe want to buy PayPal? What suddenly caused a concern, their interest on PayPal? Here's my take. So Stripe has got a huge business from a merchant side, for basically backend data payment processing, etc., in which PayPal also has a unit called Braintree. First of all, they'll take out one competition, Braintree. Number two, Stripe will also get access to PayPal brand and also Venmo. Right? PayPal still has got a decent adoption. It's got a 430 million users on its platform. It's like almost as big as a social media company like Twitter. Right? So that's a huge user base that Stripe got immediate access to, 430 million PayPal users. Plus Venmo, which is a preferred payment mechanism of, I would say, Gen Zs or millennials, right? Not used by Gen Xers, but I think that the younger generation, they basically use Venmo rather than using PayPal. Unfortunately, PayPal management wasn't able to, I would say, encash the popularity of Venmo, and that brand hasn't added much in terms of financially to PayPal's overall top line. Stripe may be able to make use of that. Third one, it's still a good company in terms of decent balance sheet, generates almost $6 billion of free cash flow, right? And have been buying back shares. So it's like a good business, but not growing too rapidly. One reason is because I think the previous management wanted to focus more on growing profitably rather than mindless growth. But if a management comes in and new management could come and buy this cash-rich company generating decent amount of cash flows, they could deploy that cash flow if they have better ideas than the current PayPal management. So I think that's the story. It became too cheap from valuation perspective. I think at the top of its valuation was more than $300 billion worth. Now it is at like a $60 billion, close to whatever, $55-60 billion. That's become very cheap. And if you are a company whose stock price from a valuation looks is not unreasonably high, and you have a decent balance sheet, and you're a cash flowing company, generally you are in the target of private equity firms or these takeover. You become a target of takeover because they're looking at, if we change the management, the business is okay. It's just that the management is stupid, that they are not able to make use of all the cash that this business is generating. All they're doing is buy back the shares, and not because they ran out of ideas to grow the business. What if we put a better minds who know how to grow the business? I think that's the story that has happened here. That's my take. Maybe Stripe, etc., have got a better ideas of how to use AI to maybe either reduce the cost of operations, or maybe use AI to generate better offering for their customer. Like Alex Chris, the prior CEO, he did come up with, he did try to, I would say, put in a lot more energy and new products onto the PayPal ecosystem, which I've seen like 5-6 years. After a long time, someone is actually trying to do some innovative stuff on PayPal. But I think he promised too much, which they couldn't deliver. And then he was out within 18 months. And now we have a new CEO, which is like probably, where they hired him from, I guess, was it HP or SAP? One of those big companies, right? So lot more, PayPal has become a lot more, big bureaucrat corporate organization, and the business makes decent money. So I think maybe these Advent and the Stripe founders are thinking, if we put the right people in place, we can extract value from PayPal. So I just pulled in, look at this. Some part of the time it was $300 stock, now sitting at $56. Right? And that's what made it too attractive, I guess. From business side, 7.9 score I consider as a decent, not the exceptional business, but it's not a bad quality. It's a high quality business in terms of, and many of these high quality companies will show up a high quality business if they are like little more mature, have a good balance sheet, generate good cash flow, show capital discipline, returning the capital back to shareholders. Only thing which I guess probably not going that great for them is the revenue growth. Look at the revenue growth. Last 5 years, it's in a single digit. Decent cash flow generation. Free cash flow yield is almost like 6%. What they do with that cash flow? All they're doing with the cash flow is buying back their shares. Look at the buybacks. If they increase the buybacks over last, since 15-year average is 2-3%, 10-year 4%, 5-year 6%, 3-year is 8%, 1 year is 10%. Look like management has no other use of capital of, hey, you're generating $6 billion of free cash flow. I don't know what to do with this, so I'm going to buy back the shares. The companies like these become a target for this takeover, and we'll see if they can grow this company back or not. But I guess that was the reason. That's the reason why it became a takeover target. But I think right now what the offer or the takeover letter, whatever the document that they gave us, it says it will still be an independent company. So Stripe will be running independent and the PayPal will be independent, but I guess it will be a matter of time before they merge these two. But they have to extract efficiencies. And I won't be surprised if we see a large amount of exodus from PayPal, because you cannot have the same management that hasn't done much over the last 10 years suddenly come up and change the character of the company. But it'll be an end of an era, PayPal. But that's an interesting one. I still hold PayPal shares. I'm a little sad to see, because this puts let's see if there is any other bidder that comes into picture. I would love to see a bidding war for PayPal. Right now, there's only one offer on the table. But, it's also what do you call, an old flame or ex of another trillionaire that we all know of. I'm hoping maybe it's just a wishful thinking that the trillionaire will go back and say, hey, I want to stake a claim. We'll see what happens. But right now, that's the only offer. And management has told that it is too cheap, which I agree. You're like $6 billion of cash flow and you're giving $55 billion valuation. Come on, that's too cheap. So hopefully we'll see the stock price go higher if there's another higher bid coming or not. So that's on PayPal. What we on the Elon or Alex Karp owning PayPal be cool. I don't know if Alex Karp will own PayPal because that will be completely I would say diversification, right? It won't be diversification, but it could be a diversification when the management goes completely out of the way, try to buy another company. But Elon Musk, we have seen Elon has made his intentions very clear that he wants to build up payments integrated in X, right? Could they use PayPal? Sure. Another reason, I forgot one more reason that why Stripe could have wanted to buy PayPal is Stripe also did an acquisition of another company called Bridge. I think, was it last year or this year, to get a foothold into stablecoin, right? They spent $1 billion to get a foothold. But if you look at a PayPal is the issuer of a Pi USD, which is again, has got a lot more adoption than what other Bridge was doing. So maybe they'll own a, or it also gives additional payment rails to Stripe to work on. But we'll see what happens. Well, that's what happened with PayPal. So if you're a shareholder, yeah, enjoy the 16% gain. But I guess I would say $70 should be, there should be minimum $70 is what they should be selling at, right? Not at whatever, $60. What else we want to talk about? Let's look at a few earnings. What other things are on docket? Okay, first let's look at the upcoming earnings, then we'll get back to the earnings of this week. What am I interested in? Nothing on Cool Monday, Cool Tuesday, Fun on Wednesday. So Wednesday we have Tesla and Alphabet. I'll be interested in both of them. IBM, I don't know how much interest will be in IBM. I think IBM, they pre-announced their earnings and the stock fell down 25%. My consolation with you if you are an IBM shareholders, but yeah, these things happen. Individual stocks, one day was down 25%. And I think after that, probably it went further down. So we'll get into it once we look at an IBM. And then service now, probably not. Nokia, Intel, Verizon. So for me, two big ones are Tesla and Alphabet. Because IBM already looked at their pre-earnings, so I have already reviewed that earnings, but only these two. What else you guys are watching? What are the earnings of that you would want to be interested in knowing? That's it? Only two? All right, so let's look at a few earnings. So TSM, Taiwan Semiconductor Manufacturing, they announced their earnings. Okay, let me get back to where I am logged into Twitter. Okay, let's get back to TSM. That was the TSM. So revenue of 36%. I think, I was surprised to see margins of 16%. But all their revenue gross margin, operating margin, everything was up. What surprised me, pleasantly surprised, was in terms of operating leverage, means the revenue grew, but their operating income grew much more than the growth of the revenue, which was a great to see. It means that a lot of the fixed costs that they have done is now, after amortization, etc., all those are now contributing to their operating income, right? So for their Q3, decent guidance, decent operating profit margin guidance, etc. For the full year, they increased their guidance from what they have given earlier. So not only they beat for this quarter, but they also increase it for their full year guidance. There's nothing that I don't like in the report. Only thing is the margin dilution will happen because now the 2 nanometer will start to ramp up. So anytime when a new technology ramps up, the margins will go a little bit down, because now they have to start because now it will start to generate revenue. So they have to now start allocating the equivalent to the cost into their books. And it means the revenue growth is not as much because they're just starting it up. So the margin will be compressed. But I guess once it get into full production mode, etc., the margin will come back to whatever their normal margins are. Other than that, I don't see any issues. I'm still happy being a shareholder of TSM. And I don't know, what you guys' thoughts are? Still, it was a good quarter. So that's on TSM. Quick look at the another one, which is ASML. Did ASML report before TSM? Or was it after? No, that was before, right? ASML, same stuff. Their revenue was more than what their guidance was. What helped in the revenue was their installed base. So ASML is a company that make the machines that actually make the chips. I mean, not entirely, but there are a lot of machines that goes into making chips, but this is one critical component where you will etch the design of the chip on the wafer, and ASML makes some of those machines. Some machines that you need to create these high-end chips, which is like 7 nanometer or narrower, you need extreme ultraviolet lithography machines, and ASML is the only company in the world as of today that makes those machines. So they have an absolute monopoly on that machine. Okay. But there are two ways in which ASML make money. One is the servicing of the machines that are already being sold, and number two is sale of a new machine. So what they've already sold, that's what they refer to installed base business revenue. It was $2.8 billion against $2.3 billion what they've guided. And then the rest is their new sales of the new machines, etc. What's more heartening to see is their high NA EUV machines, which is the latest model of their EUV. There were two customers that they bought it. I think SK Hynix was one, and Intel was another one. Intel is the customer that actually, after testing, now moving into the production side, means they are running it at whatever the full utilization as you would run in your production environment. Remember, each of these machines, single machine, cost you anywhere between $300 million to $400 million, single machine. And the overall cycle for installation, then testing, and then ramping up and up to the production could be a few quarters. So it's not like you ship it and it's right there and start to make money. So it goes through all those tests, etc. And now good to see that high EUV has now transitioned into production. There was a news that Intel is a customer. Hopefully SK Hynix is still testing it, and if they approve it, they will be, these machines are higher value machines, little lower margin than the other machine that is in there. But overall, things still look good, right? And what they also saw is a demand from a lot of their memory customers, right? Microns or the companies or let's say TSMCs or the other fabs that need these machines to create memory chips. So memory growth, revenue growth is 75% up, right? The overall, which will include their EUV as well as DUV machines. Anyway, they also continue to buy back their shares and pay the dividends. And now they're increasing the capacity by 30% for 2027 and potentially another 30% by 2028. So only red flag that I see in this one is TSMC. So TSMC earlier had pushed back saying, oh my God, these high-end machines cost too much. So we would try to use a different techniques. There are, if you dig deeper into it, or you talk to any people in this ecosystem who work for semiconductor companies, can give you more details. But there's something called multi-patterning, in which you really, you could, instead of doing the design imprinting in one go, you basically do it in a multiple steps. It's like you have your wafer, you shine the light, it creates a design, move that wafer like by a nanometer left or right, and do again, shine the light on it. So the whole idea is, instead of doing it in one go, we could do it in multiple steps. That's called multi-patterning. In that case, if you do it well, then you really do not need high-end machine. You can use the older one machines, but then your time to do to create the wafer and the yield goes down. So the whole idea, there's a total cost of ownership discussion that's going between the TSM and with an ASML on. Maybe I live with the older machine and process, I spend more on the process, or maybe we'll move to a high-end machines, get a better yield and a quicker one, but it will cost us more. That's the only one which I'm saying. Both ASML and TSM are not, I mean, if you listen to their management, they are pretty friendly to their customer. They're not price gouging, because both the management are, hey, we are in here for the long term. We don't want to gouge our customers just because they need these things right away. We're going to be long-term partners for it, and I guess they'll figure out a way to sell these machines to TSM also. Okay. So I think I am still okay with it. Another tailwind is they cannot sell their EUV machines to China just yet. But if US and China, have some agreement and in some give and take, if US removes those export control restrictions, and if ASML is able to sell this EUV, that will be all additional revenue that is not accounted for in the current projections. Right. ASML unlikely China export where, I don't know. I mean, China is already trying to build. They did a prototype of generating EUV. I guess there'll be a few years away before they are able to generate, maybe 5-10 years before they're able to generate their own EUV machines. Anyway, so that was on ASML. I still own ASML, and I think I'll continue to hold it. Again, when you look at a business quality, and that's what I want to focus on, it's still a great business to own, right? So both, and this is why I mean I would rather own ASML and TSM than some of these other high flyer stocks, but not that great of business companies. So let's quickly look into, let's say, ASML or TSM, ASML. I'll get the data, but it trades an exceptionally good as a business, right? May not have that much of a growth. It doesn't grow at 60%, but from a business side, it's been an exceptionally good business. Or even if you look at a TSM, same stuff. What should the examples of high flow stocks of other companies? There are a lot of companies, NFLX, CoreWeave may not be a great businesses, but right now, these stocks have been, or SanDisk, Microns of the world, right? The stocks are like through the roof. These companies, have they been able to back the business? If you look at their past history, have they been able to manage their business through these cycles really well? Not that great, right? But these cycles will go. I mean, right now everyone needs memory. These cycles will go away. I want to look for next 10 years, 15 years if you want to build a position. Right? All right, so that's on ASML. The third one, we also had IBM report the results. So let's look at what IBM, any holders of IBM. I think I did tweet about IBM. Hold on, where's that? IBM. All right. So what happened with IBM? I don't own IBM. But what happens? There was almost no revenue growth. The revenue grew only 1%. And the margins were down. So essentially, lackluster revenue growth, compression in the margins. Did that happen because of the external environment? I guess sure, some of it. But then during the call, management did talk about internal failures, right, in adapting to shifting market conditions. When you and I, we probably know that all the companies, they are scrambling to get their hands on memory chips and the high bandwidth memories and all that stuff, right? And also after the Mythos came out, there was a lot of widespread concerns around, hey, are our cybersecurity and how are we doing, how are systems in terms of resilience to attacks and all that. So what IBM says that they realized just a week ago, and again, I'm not verified, I think I read somewhere on Twitter, that, oh my gosh, all our customers are saying, like a lot of their customers are saying, sorry, we're not going to buy your system because we are using our budget in this quarter for spending money on cybersecurity, spending money on buying servers for a high bandwidth memory and all that stuff, right? On the AI related expenses and on cybersecurity. So they moved their CapEx towards server, storage, memory purchases, and hence they did not buy whatever IBM is selling. And hence their infrastructure revenue growth was down 7%. Consulting growth was almost none. So Arvind Krishna, he acknowledged that, yeah, this was a failure on our part. We should have seen this coming. Right? And market didn't really like it. Stock got punished, down 25% in a day. And if CNBC hosts are correct, that was the worst ever performance of the stock in the history of IBM. I guess probably it is in terms of how much of a dollar value of market cap it lost. Someone can fact check it if like, maybe I guess some companies go down bigger drawdowns or could have had a bigger drop in a day of more than 25%. But I think the amount of dollars it lost was huge. Maybe close to $60 billion worth of market cap lost in a day. That was the worst day. Now they are announcing their regular. So this was a pre-announcement because I think CEO and for sure general counsel would have had a conversation saying dude, this is a huge miss. This is a material information that we are now figuring out a week before the earnings is coming due. We should announce it to the market, because this is otherwise later on, those lawyers will sue them saying, why did not tell us before if you knew it a week before? Anyway, now the earnings, I don't know what's going to happen on earnings. Probably it'll be more of a Q&A and how the management will address these questions and address these concerns. That's what we will see. So what else had happened? Yeah, execution failure, client is shifting the buying patterns. Those are the big things on IBM. All right, the last one is Netflix. Did I tweet about Netflix or did I only generate the report? One sec. Netflix, I did. Right. So Netflix reported results. Right. Stock is down, was now down 9%, is now back to $68. I think earlier someone said, was Andre probably said, Netflix looks cheap at $100. Now it looks even cheaper at $68. Right. So revenue was up 13%. Unlike what happened with IBM, which revenue growth was almost null, it grew 13%. A little bit compression on the margin. That's okay, not too bad. So what happened? Right. Total view hours were also $97 billion. Projected ads revenue for this year is $3 billion. Most of the things was like up. Two things that happened. Number one, it was nothing to do about the current quarter for which they reported the result. It was all about future. Management forecasted the revenue of $12.86 billion, which is 11% growth. And that is slower than what they've grown in this current quarter, or should have been Q2. So they grew almost 13.84% in Q2. In Q1, they grew 16%. Now the management is thinking maybe they're growing, but the growth is slowing down. For a full year 2026, again, they are guiding at a 12% growth. In 2025, for a full year, it grew 16%. Now the question is, it's not a dying business. It's a growing business, but growing at a slower rate than what it used to. In my opinion, these are the 4 reasons why the stock sold off. You could have your own reason, but when I looked into the earnings report, number 1 is, of course, we talked about a decelerating growth. Quarter over quarter, full year projections, hey, our growth is slowing down. Number 2 is slowness in viewing hours per member. So the members have increased, viewing hours have increased, but the number of hours watched by per member, that has decreased. So, and management say, hey, that should not be the right metric that we should look at. Now they're changing the metric. So every 6 months, management used to provide a report called What We Watched. Now they are saying we'll not share this every 6 months. We will maybe give you insight into annual cadence, because this does not drive our revenue. This does not impact our revenue. And anytime, and I've seen this in multiple companies, is anytime you change the metric or you withhold a metric from an analyst, something start to happen in the back of a mind, and I think, you're hiding something, right? Or maybe the numbers don't look good anymore, and then that's the reason why you don't want to share with us anymore. It will be some time before analysts go back and look at it and say, is it really moving the needle for it? Because Netflix has grown over the year, right? Subscription growth, they already told that they will not be focused and will not be providing numbers on user subscription growth. I think maybe it was the 2 quarters. Someone can correct me, but somewhere in the last year they mentioned, don't focus on subscribers growth. We are beyond that. We want you to start focusing on the revenue growth and profitability. Now they're also saying, don't focus on number of hours viewed per number of hours per member. The analyst like, maybe something is different, right? Anytime you withhold a metrics, change something, they have to go back and change their models and all that stuff. Never a good picture. Fourth, Netflix expect that the content amortization expenses will increase by 10% in 2026, right? Which means if your expenses are, so revenue is slowing, your expenses are increasing. Not the best picture you want to be in if you are an investor, right? You want it to be the other way around, right? That's where the stock got punished. It is already beaten up so much and got beaten down further after they announced these results. So let's look at Netflix. I don't know, is it too cheap? I don't own the stock, but given where it is, do you think it's too cheap? Who owns Netflix? What's your thesis on Netflix? It seems to rank decent on the history, but I think any investment has to be a combination of demonstrated performance and story about future, right? Demonstrated performance or the history seems to be okay. I think the concern is in future what they're going to do. Now look at 2025. 25% margin with decent free cash flows. Okay, no insider sales, insider buys. Insiders haven't bought, but from a valuation perspective, looking at 11% growth in free cash flow, that's what being priced in, which is at a discount of what the analysts are thinking. So, yeah, I mean, if we believe that, if we believe what the analysts are thinking, that they're gonna grow their EPS by almost 15%, and maybe I should have a FCF conversion ratio right there, but let's look at what the conversion ratio is.
15% is anemic growth rate. It's not a growth stock.
The revenue, not is the earnings. So that's where the stock is, right? A slow growing company can be a great investment if you pay too less than where it is, what it is worth. A high growth company can be a bad investment if you pay too much, right? At the end of the day, the deal is how much you're paying for it. Yeah, so it's a 9, analysts are expecting 10% revenue growth, 15% EPS growth, and they've been able to convert 80 to 90% of their earnings into free cash flow. So assuming 90% of EPS getting converted to free cash flow, just from the model perspective, discounted cash flow perspective, yeah, $68 seems to be cheaper, guys.
If you take a spectrum of growth stocks, quote unquote growth, right, where the word growth is characterized by how the financial investment industry treats growth, I think this would rank at near the bottom, because you have
not a growth
200% growers in revenue and 1,000% growers in earnings.
It's not that's what I think, that's where the Netflix has been trying to tell analyst community, don't look at our subscriber growth. We are no longer should be considered as a growth company.
So this is like in the sphere of turnaround stocks as opposed to growth stock or value stock.
I don't think it's a turnaround. It's more of becoming a mature business. So it's not the maybe my definition of turnaround is that the business got broken and now it's not being turning around. I don't think that the business got broken. Stock price has been punished. But from a business side, it's trying to mature. it's not going to grow as fast as it used to, right? It looks like a revenue growth. If I'm looking at a revenue growth, shut that out. Look at a revenue growth. I don't know where they, okay.
Your
Yeah, so
PEG ratio
10
is
years
very
growth was
low.
20%. Now it's the growth is like 3-year growth is like 12%. The growth is plateauing. It's becoming a mature business.
So Yahoo Finance Statistics is showing a much higher PEG ratio than you are. You're showing 0.69.
Yeah, we don't know what they're looking at, a forward one or a second. But in any case, I think the idea is Netflix is no longer a growth company. If that's your investment thesis on Netflix, that's a growth company. It shouldn't be. It ceases to be a growth company. They've been hinting the analyst community that we are not a growth company. We are now becoming a stable, mature company. Value us on cash flow generation, value us on profitability, and not on subscriber growth. Last year they told analyst. Anyway, so that's looks to be, but again, I don't think I want to add any other individual stock right now in my portfolio. So I'll give it a pass. But if a slot opens up, won't be too, I mean, it's at a much better valuation than many other companies for Netflix. But you also have to think about the future, because the numbers only tell the past. What's happening in the future? YouTube continues to grow stronger and stronger as a competitor, right? I don't know about how this Paramount and what the company that they, no, I can't remember the name of that company. Skydance, Paramount, and that merger stuff, how that dynamic is going to play out. What's happening with the Disney stuff, right? Streaming itself, I think as a business model, streaming itself is becoming a mature business. Is no longer a high growth business in itself. Right. So as an industry, streaming is maturing. So, and I think maybe the Netflix is the best of the worst players in the streaming business. So that's why it could be. I don't know, guys. I don't own this. But if a individual stock position opens up in my portfolio, looks to be at a decent valuation. That's all I'll say. Any other? No, I think these are the only 4 earnings I had. Quick update on crypto. Let's skip some of that. I think skip this. Not about crypto. So Citadel, Ken Griffin is back. He invested $400 million into cryptocurrency from crypto.com, which values it at $20 billion. So probably Citadel wants to be a big player in, maybe, I don't know, maybe in becoming a market maker in now crypto side. I didn't read into why they did it, but that's the one big news. Number 2, bigger news is Japan passed the bill recognizing crypto as a financial product. So now in Japan, owning crypto and owning stocks is considered same from a treatment perspective, right? So it means if you are a regulated products, or if you're running a firm that deals in regulated products, and if you allocate a capital to a crypto, you will not be looked through suspicious eyes. Hey, if you're allocating to a stock or an ETF or a fund, you could allocate it to crypto also. Third, any gains on crypto now will be treated at the same rate as if your capital gains from your stock investments are. There are countries in which your gains on crypto are taxed at a higher rate. India is one such country I know of. If you own a crypto and you get a report of crypto gains, that are taxed way more than what a normal capital gain tax rate is, right? So And we saw that after this announcement, at least one pension fund saying their board has authorized to allocate 1% to a crypto fund. While Japan have been able to pass the regulations, right, we are still stuck on the Clarity Act. We haven't progressed much on the Clarity because it's stalled in Senate. We are still going back and forth on the ethics provisions. For a change, I am with Democrats on this one. Yeah, we should not have politicians be able to benefit by, whatever. Like Donald Trump made what, $2 billion of gains on crypto, and by shilling those worthless stuff which a lot of our followers had bought. So I think the ethic provision probably prevent all those, and Republicans don't want that in, and Democrats say they're not going to sign in until we have those ethic provisions added to it. So we'll see where it goes. Right now, looks like the betting market shows only 36% chance of passing before 2027. That's not going to be good for US or the players that want to give a clarity to the companies that want to play in this ecosystem. Right. So yeah, we'll be behind on this. Maybe I think Hong Kong already passed regulations. Japan already passed it. EU is already ahead of it. We're probably far behind. But while the regulations are being worked upon, DTCC, if you are in the stock market, all the records of who owns what is actually maintained by, this will be with the DTCC. So if your Charles Schwab goes bust, it's okay. Breathe easy, DTCC will have your records. But now DTCCs, they just started a pilot for a few stocks and the bonds, and having a record keeping using the tokenized. So basically having a tokenized stock and some treasury bonds. They're working with JP Morgan, BlackRock, Goldman Sachs, and the whole thesis around real world asset tokenization, it's happening. Now DTCC has started with it, and I think they have selected, if I remember correctly, they have selected Chainlink to be the tech behind it. But forgot what the timeline was. I think the first, somewhere in November, they'll go back and look at it. Okay, how successful this has been, and then the eventual goal is to tokenize all these financial assets, so that then you can. Right now we're at a T+1 settlement. You can get into T+0 or instant settlement like we have on a crypto. Right? It pains me to see if I have to send money to somewhere over ACH without paying exorbitant fee, it will take 3 days to settle. Whereas if you're on a crypto rails, right, it's like an instant settlement, right? But it is what it is. We are far behind in all this payment tech, man. It's pathetic. Coming back to this, so yeah, so why even have a T+1 settlement if we can have an instant settlement, right? So that's what DTCC is focused on. And they started with a handful of stocks and with a handful of Wall Street companies. Total market for tokenized RWA reached between 24 to 30 billion in 2026. BlackRock already did a US Treasury fund. Now that's above $2.5 billion. What else? Little more progress on the stable coin. Looks like a consortium of 140 companies launched a new stablecoin called OpenUSD. I have no idea. But OpenUSD will give a yield from its reserves. Maybe I need to look more into this. Has anyone looked into OUSD? But a lot of attraction on the stable coin, because with the Genius Act, at least we got some clarity on the stable coin side of the house. And we're seeing more and more institutions jumping onto the stablecoin stuff. So that's a quick update on crypto. We're already 12:20. Let's skip macro and all that. What else we want to talk about? I can be around for another 40 minutes. But I guess let's any other interesting chart? Ooh. Well, I think let's call it a day here. Let's talk about anything else that you have in your mind. What else going on? Shall I open the breakout room? Let me open that. All right. So we want to talk about day trading, etc. Go and talk to the people who know about day trading a lot more than I do. But I know very little about anything around day trading. Sorry, I can't help you. But there are other people who can.
I could definitely help you guys out over there. Hey, Vivek, I had a quick question about option volume. Like on the Charles Schwab website, I sent out a text earlier. It says unusual option activity. And like on Charles Schwab, every day they have like, oh, there's a lot of unusual activity. There's like 12,000 contracts. Somebody put $12 million on this strike price.
Yeah.
3 months. Like, is that insider? Is that kind of like insider trading? Like you can just kind of follow what these people are doing because they're putting a lot of bets. They're putting a big bet on one strike.
Yeah, but you don't know what why the reason they're putting bets. So in a think or swim, you can see the unusual options activity. They'll have an alert sector. I think there are some services that actually charge money to give you unusual option activity. But I don't know if you can consistently make money by looking at unusual option activity or not. Reason is, let me ask a question, right? I bought a call, right? Am I bullish or bearish?
It depends on like how far out. You
No,
can
that's
tell.
fine. Let's assume I bought a call at 30 delta strike price. What do you think? Is that person a bearish or a bullish?
Well, if it's like only a month, I'm assuming it's bearish if it's out of the money. But if you're buying like 5 months, 6 months out, that's bullish because I don't think
Or
anybody
let's say
would
I bought a leap call at 30
Unless
delta.
you know the position, unless you know what's the marginal impact on the overall.
Exactly. So what could have happened?
All kinds of things. Right? These are all little specks of dust in a whole sandstorm.
Here, let me tell you this. My friend works at SLS, the company that I put in the chat. He told me that, hey, we have this trial. We just passed good rating. This was when the stock was at $120, right? And now it shot all the way up to 15. And he was like, hey, I'll let you know there's rumors that we're going to get bought out. And then I find out on Charles Schwab, it said SLS, unusual activity, 9,000 contracts. Somebody bought $12 million worth of January 2027 $15 strike price for $6 premium. Like, to me, I just connecting the dots. Somebody told me, I know somebody that works there, and he told me it might get bought out. And then all of a sudden, I see this unusual option.
So look at Rajiv's message.
What did he say?
Yeah. So those trades, if there's are insider trades, they get prosecuted, etc. But what I'm trying to say, we only get to see the trade that's done. What we don't know is, let's say I bought a call. It could be because I sold all my stock position, and then I bought a call as just in case, right? I don't want. It's just like my what do you call a schmuck insurance. Hey, I sold all my positions on, let's say, CrowdStrike, but I don't want to look like fool if the CrowdStrike goes like become 2x. Maybe I'll buy some calls. So even though I'm not bullish on CrowdStrike, so you never know what the actual thesis behind that is because we only see one portion. Or the other way around, right? I bought a put. It doesn't mean I'm a bearish about the stock. I bought a put as an insurance. I hold the stock in my portfolio. I just bought a put as an insurance, right? If I buy an insurance on my house, it doesn't mean that I wish my house to burn down. No. So we only get a limited visibility into the unusual stock options activity. So, but some people, like maybe if you consistently follow, if you know that someone, individual trader who has consistently made money in that, maybe sure follow that, but I don't know you can get in that in-depth information or not.
Okay.
My only idea is we can never determine from looking at an option trade what the outlook of it is. What I should do is seeing someone bought a call and then say, oh, he's bullish about it, I go and buy the stock. Because he could be bearish about the stock. We don't know. And that's what I do, right? I sell calls all the time. Doesn't mean I'm bearish about the stock. I'm just reducing my cost basis. And that's why I always tell that don't follow just by looking at the stock. And at least I do write down in my notes why I'm doing this, so that you guys know, okay, this is what I'm doing. But yeah, so but this information is available. Once in a while, you'll hit a lottery because you followed someone, but I don't know if you can do that consistently or not. I've not been able to do it. I heard, so maybe you should listen to, there's a whole bunch of a podcast, right? Option Insider guy, that Mark Longoff. I haven't listened to them for many months. I forgot his name. But they do cover this unusual options activity. And good thing about that is they'll go back a few months later and then they'll say, oh, we talked about this. What happened? And like I used to listen to them regularly in 2020, I think till 2023 or 2024. And it's like a hit or a miss. Sometimes they'll talk about someone bought 9,000 calls and then 3 months later they say, oh, all of them went waste. Right? They all expired worthless because nothing happened. So you can never tell. That's my feedback. What else? Carl, do you view rates as entering a stable regime or a volatile one in item? I'm not that smart, Carl, but market is pricing in 50% probability of a rate. 50%, nothing much, but it's like a 50-50 of a rate hike this year. I think Wallace speech, was a speech or interview, whatever it was, Governor Wallace, he did mention that from a Fed perspective, they are still, the inflation is not where it should be, and the Fed is still looking, won't be averse to hiking the rates this year. But if inflation number comes down, I mean, this week inflation numbers were lower than what we were anticipating, and the labor market was weaker than what we were anticipating, and these both will basically should force a Fed to not hike the rate. So we never know what's going to happen in a macro level, right? And I have no idea. I'll be very frank, I don't want to come and tell you something which I have no idea. Well, that's what the market, I can only tell what the market is assuming. CME probabilities is 51% of a 25 basis rate hike this year. Yeah, Rajiv say, yeah, look at the rates forward curve. Yeah, either look at the curve or the probability tables. Now, we thought that, US Iran will get a truce and we should see the oil prices coming down, and hence it should start, the impact will start to show up in the inflation numbers. But now it's anybody's game. I don't even know what the latest status is. The status keeps changing. We start bombing. Now I think that we're starting bombing not just the military targets, but it has become much more widespread. If oil goes up higher again, the inflation number will start to go up higher. Yeah, so macro, I'm not a macro investor. It's too difficult for me to invest based on the macro thesis.
No, I was asking your opinion on this Korea started, in my view, a contagion on the financial markets in US. Do you think it'll continue into the US financial markets over the next few weeks, or
The Korean contagion, I don't think the Korean
it's not?
contagion will cause us much worry.
Oh,
I mean,
okay.
we were only talking about so Korea got impacted because their market is so concentrated. Like on our side, if let's say SK
It's all
Hynix,
connected, right? It's all connected. Like they created ADR for SK Hynix, the
yeah.
Micron
So let's say two or
trade
three
is
companies
dependent
goes.
on, huh?
Let's say Micron or let's say SK Hynix or Micron stock drop by whatever 10-20%, right? Because of the structural connection that you're referring to, and not because there's an AI scarce. It's okay, right? Two companies doesn't matter for a US market, but in Korea it will matter if the SK Hynix or Samsung craters 50%. Korean stock market is like gutted because these are a huge companies in Korean stock market. But if so, I'm not worried about the Korean market causing impact. What I'm more worried about, if we get concerned on the overall AI story, if that gets cracked. So I'm more worried about that. So why do you think the Korean story will cause a widespread?
So basically, the story or narrative stuff is like the fundamentals part, or things which underlie the slow movement of capital over, let's say, 2 years or 1 year, right? But in the intervening or forthcoming 7 months, like you will have financial capital impacts which are caused by things such as the Korean contagion drawing down. There's a deleveraging happening of that capital. That capital will have to be sucked out of things which are fat ladies, such as say Apple stock or Micron stock, and that's where some of the drawdowns have been happening. So it's all interconnected. So when I say the AI story can stay intact for another 3-4 years while there will be drawdowns of 10-20%. And to address Nick, you have to actually take out your capital while you are ahead. Otherwise, you'll just be
Oh yeah,
riding.
so see, I'm not worried about the market going on 5% or like 5 to 10%. I thought when you referred the saying there will be
It could be
contagion
more.
impact
It
over
could be
here.
much more because semiconductor sector is a very big component of S&P 500 today, right? I guess the
Yeah,
tech
but let's
sector.
say I don't know in terms of in terms of amount of a capital that's been invested in SK Hynix, etc. That if those go down, margin calls, etc., happen, and the other investors have to sell their Apples and the Googles and the other stocks. That will be contagion. I think what you're referring to. But me personally, I don't think these companies have got a huge so big an investments from US investors that it'll start to have impact on the overall financial market. That's my personal opinion. I don't think these are too big. Last 3 months, all semis went up, so no fundamentals in place. No fundamentals riding this market. All right, if you want to trade on the news, Trump mentioned that he is willing to share his tweets with some high-speed network. Go and subscribe that. Can you provide a viewpoint on SpaceX? Still pretty expensive. It's all based on a future story and future growth. Nobody knows future. If your viewpoint of what Elon is promising and you think that you think that could become a reality, then only buy it. Okay. They had to cancel the launch of the Starship because of some issues. So all of their future growth is based on, I think the majority of the future revenue projections and the addressable market is based on the fact that they will be able to become one of the biggest player, if not the biggest, in the AI segment. $26 trillion of total addressable market out of 28, what they mentioned in their S1, is the AI play. Right? If you think that AI play will work out for them, that XAI will be on the top of a leaderboard, or XAI will be able to grow their data center leasing revenue, then yeah, invest in SpaceX. I want to give SpaceX a little bit time to prove to me, so that I don't want to go big on SpaceX right now. Right now, it's a gamble for me. I am not able to visualize that how SpaceX can become and capture $26 trillion worth of market, become the biggest player. Rajesh says short position. I won't short. You know me. I don't want to short a single stock. But I'm not right now. I'm not bullish on SpaceX. I know the stock is now. If you're interested in buying it at an IPO price, it is cheaper than IPO. And we talked about it during IPO. I'm not going to touch it. There's some who bought during IPO, request a broker. I'm like, it's too expensive by any metric. Any other stock?
How about take two, TTWO?
TTWO. Let's look at how the Take-Two company is.
They own one of the biggest IP, intellectual property entertainment in the US.
That's okay. Can they make money by owning that intellectual property? I mean, 23andMe own a lot of intellectual property, went bankrupt.
So you know that video game Grand Theft Auto 6?
Mm-hmm.
So they've been trying. The last game, Grand Theft Auto 5, made billions of dollars, but they had delays for the Grand Theft Auto, even though so many people wanted it. It's been a decade since they last released Grand Theft Auto 5. So all the young kids, everybody, they said, oh, we're going to release it this month. And then they delayed it another year and then another year. So much hype is being built into this game, which sells $1 billion worth of video games, that the hype going into November, they finally released that November 19th is the release date of the video game. It's going to smash all the records, all the movie records. It kills all the other movies, music.
Sure. Maybe want to trade it. Historically, hasn't shown me that it actually can know how to run a business. This company has not shown me how to
well, they got a big video game. Yeah, they have a big video game, Pimped Up
So
Demand.
it's all about future, right? So you can take,
Yep.
yeah, you can, if you are a confident about future is anybody's guess, right? At the end of the day, it's the future. That's why it is future. It's anybody's guess. Your guess is better than mine and more optimistic about Take-Two. Take a position. Take-Two has not shown me over the last 15 years that they know how to run a business.
How so? Analyze some of the analytics that makes it kind of like shaky.
Your voice is breaking, so I couldn't hear.
What are some analytics that say that it's shaky?
So last 15 years, never made an operating profit. You can grow your business to infinite if you buy for $2 and sell it for $1. Things that cost $2, you want to sell it for $1, you can grow infinite. You don't have to tell me Grand Theft Auto 6 or 7. You can grow that business infinite.
So it is year 2000 and Amazon was like that. Amazon was famous for basically doing exactly what you're saying.
Yeah, but here's the deal, right? Where did Amazon look at the operating the income, not net profit, but Amazon was building an infrastructure which can then later capitalize on. What is Take-Two building, which is given a moat on their business? Show me some kind of that. I don't know the story about it. That's what I'm saying. I'm not saying don't invest in it. Historically, they haven't shown it. Maybe they're building an infrastructure which nobody else will be able to replicate and will allow them to capture the whole future growth. I don't know about this business anymore. I mean, I know what Take-Two does. It brings its game. I don't know what kind of a mode you're going to put around it. Only mode you'll have is your brand name for that games. Right? There are a lot of other gaming studios. But if Grand Theft Auto, what, number 6, I'm not a gamer, so it means there have been 6 revisions already. I haven't been able to make money on that brand name just yet. How long do you want me to wait? What Amazon did was building the economic warehouses or the logistical infrastructure, which other competitor can't just come and copy and paste it. That was a very different story. This is a very different story. I mean, I own some company who have not made an operating profit, but the way where they're investing in actually give them a lot of pharma companies or the biotech companies will never make money. But if they're investing everything, which is giving an IP protection, well, that's what they're gonna milk in the future. I don't know what the take two is. Do they have an IP or what is in this game, or what are they investing in that's building a moat around their business? I don't know that. But if you know it, yeah, then taking these losses is fine. If these losses will allow you to capture a lot of a market of gaming industry in future. I just don't have the visibility around this industry. So I can't invest in this. So that's a little different. Right? SpaceX could be one wherein, hey, they never made operating income, but the kind of infrastructure they're building and the market is big enough. Yeah, could be a business I'll be interested to invest in, but I don't know about the gaming stuff. All right, what else? Intel. Intel is expensive to me. I mean, I was tempted to sell a short put on Intel because some of my shares got called away at 85. And now I'm thinking maybe I should acquire it back at 85, maybe sell a short put on Intel at 85. But still with 85, I think Intel whole story is the business from, let's say, Apple's and all other companies that they've contracted with, but they still have to produce and sell even a single chip to them. It was a great buy at 17. When we talked about it in the meetings, I think doesn't deserve to be at 17. But I don't think it deserved to be at whatever 95 also. They're investing in, so now let's look at Intel. Right? Now these negative operating margins, I'm not that concerned about right now because these margins are negative because they've been investing a lot in fabs for their new business segment, which is building and supplying chips to others, not for their own consumption. Right? And which is why now the Apple is contracted with Intel, and I think probably they'll announce some other customer also. Now the question is, will they be able to execute on it or not? The current valuation is based on assuming that, yeah, they'll be able to execute it with a good yield and be able to capture it against, some market share from TSM. I just want to see it. If it is at maybe 50, 55-ish, 60-ish, that time maybe I'll sell a put. Right? It still be expensive. The question is, how much margin of safety you want to have? Right? It is still expensive. It is expensive at 95. It will still be expensive at 60. But the question is, maybe right now, 95, from my perspective, the gap is too big. Right? That's the only one. It's all about their future fab business. And if that doesn't work out, there's nothing much left in Intel. It's a strategically important for US, and the US government stake might save it, but I don't know how much growth will be in it. So I'm just waiting for the Intel fab to come online and then start supplying some chips, or at least give me an indication that the yield is good enough. There was recent news that they had an 85% yield, which is considered as a production grade. But let customers get the chip and use it and say, yeah, that's good to go. What else? Any other to SpaceX? We talked about Intel. We talked about. That's it. All right, 7 more minutes. Then we have to head out. We're planning to maybe go to a, kind of a sports bar and watch the match over there and have a lunch, some pizza lunch and a match. So I can't hang around much. My family will be, Dad, come out. What else? Any other guys? Give me some new stocks. We haven't talked about anything new. These are names that we have discussed earlier also. Nobody looking at any new stocks? UNH. Yeah, I think the UNH announced the results. I don't have the results with me, but no, let me get the result, or at least create the okay, hold on, let me at least start off the I don't is this is the previous quarter result, right? So hold on, let me at least try to get a result for this quarter. I always take some time for the results to show up. So UNH, it's a low margin, but steady business. More, this is the business where it's on a mature, like they're like a mature business, not too much of like 10%, 11% revenue growth. Eventually, I think it is growing at least higher than the GDP growth, which is better. And generate decent amount of cash flow, which they basically buy back some shares and give the dividend. So it's okay. It's a mature business in an industry which is regulated. So you cannot just go and grow your margins the way you wish to be, because the government will come and shut you down, or government will basically exert a pressure on you to in terms of for whatever for charges for your services, etc. So it's a normal business, I would say, right? I think the stock price reacted to maybe the earnings. We'll have to see how the earnings did, but that's all I can say about UNH. Okay, gives buyback from a valuation perspective, fairly to be free cash flow growth last. Okay, so seems to be fairly priced in. Over last 5 years, they've been basically reducing their cash flow. Right now, the market is implying 4.5% of free cash flow growth, and analysts are estimating 5.5% of revenue growth and 15% of free cash flow growth, right? Allowing a discounted rate of this, let's say 4% instead of 5%, we give 6%, 476. It is fairly valued. I don't think it is, from a cash flow perspective, it is very cheap right now. But it's a more of a dividend and a buyback share. It's a very mature business in a regulated environment. So be aware that with the change in government, these businesses could go anywhere. That's why I don't invest in this, because any bill from a government could basically change its fortune in either way, right? Suddenly we realize, okay, the government has changed in terms of how much the reimbursement policy for Medicare will work. You will see some of these companies' stocks go up and down, or their future prospects will change completely. And I don't control government. I don't know what government had in its mind. That's why I don't invest in UNH. But it's okay business, not bad. Cannabis stock. Cannabis is all about future. Looking at the numbers for cannabis, I don't know, TRLV. These are, if these are OTC stock, then I may not even have the data for this. But to me, it looks like all the at least in the US, all the cannabis stock are a story of the future. It's all based on in terms of what the schedule change on the cannabis will happen. There is nothing much you can glean from looking at the past financials. So, I mean, I will just ignore all this stuff. The company is there for 1 year, so nothing to look at it anyway. It's all about what the government can do. And I don't know, we were hopeful, there was some news saying they're going to remove it from Schedule 1. If that works out, great. Otherwise, I'm not going to touch any one of these cannabis stocks.
Hey Vivek, how did you create this platform? You know how you used to use the other website like Stock Chart to do your fundamental analysis?
Yeah, but then I used to export data from it and then run it in my own Excel and all the stuff. I'm trying to consolidate everything at one place, so I don't have to do, gymnastics in 10 different places.
So
All
you
right.
created your own app here to take that
Yes.
same info that you
Yes.
were looking at?
Okay,
Nice.
so that's a demo account, right? Yeah, so I mean, so at least in this, I can go and see, let's say, against my own portfolio, who else owns this, right? Which funds own this, how they moved back and forth on this one. I can add whatever functionality that I need, for my own purposes. So everything that I used to do on Excel, etc., are moving here. So yesterday I added something called ETF grade, right? Which is basically, I want to see an overlap between various ETFs and what shares that I own, and if I'm trying to buy another ETF, then I want to SCHD, right? I'll tell you, do I already own these stocks in my portfolio or not? What's the overlap, etc. So this is I added yesterday. So it is an evolving stuff, but it helped me over the years, things that have helped me to become a better investor. That's what I'm putting everything at one place. Okay, all right. So we are just hit our 1 o'clock mark. So I gotta go and hopefully talk to you guys again next week. We'll see how this week goes. Anyway, 1 week doesn't matter in years or decades of investing, but we'll see. Don't go touch grass, go walk in the sun if you feel that, market is becoming too much volatile. Get away from a computer. I personally try to get out by 12:30, which is 30 minutes before the market close, so that I don't make any stupid decisions. There's a very few things that I will trade after 12:30, because what I've realized, anytime I become under time pressure or little take decisions under emotion, because, oh my God, market's gonna get close, I need to do this, doesn't end up, most of the time it won't end up well, right? So idea is, hey, let's move away. You take a decision when you are in a cool mind, not under time pressure, not under emotional pressure. Go walk in the sun, touch the grass, go out and play, get away from computer when the markets become too volatile. All right, guys. Yeah, Ramesh said, make some cookies. Not that great a cook. But yeah, that's what I try to get away at 12:30 to make lunch. Bye-bye. See you next week.